Hello, everybody. My name is William George, and I work on the acquisitions team at Excelsior Capital. Today, I just want to take a few quick minutes to discuss what I think is important for an investor to focus on when doing due diligence on a specific real estate deal. In reality, the first thing you want to consider is this type of investment suitable for you? But for the sake of this exercise, let's assume a private real estate investment is something you're looking for in your portfolio, and that you've already are comfortable with the sponsor that has given you an opportunity to invest in their deal. So when given the due diligence package for a real estate opportunity, the first thing that everyone thinks about is the location. And obviously that's very important. You want to make sure that the building or the development, whatever it may be, is in a city, in an area that you believe in long term. 5 years from now, 10 years from now, is this block of land or is this city, this submarket going to be coveted? Is it going to hold value? And that's kind of the first item you want to check off your box, because if you're buying a really high quality building with high quality tenants at this time, but it's in a location you're not very sure about, that's a lot of risk to absorb in a real estate investment. So you definitely want to focus on not just the city, but also the submarket it's in. And I'd always recommend, checking out how that area in general performed in previous recessions, how it's done now that we're kind of 2 years into the pandemic, how it's performed over the last 2 years as well. That'll tell you a lot that you need to know. The second item I think it's very important to focus on is the property's rent roll and or its tenancy. What kind of tenants are in the building? Do they fit the profile of the building? How long are their leases in place for? Does the anchor tenant, are they of credit quality? Do you believe in the anchor tenant? Are they locked up long term? A lot of those questions can have different answers depending on the type of investment that you're focused on. But for the sake of this exercise, let's assume you're looking for a cash flowing, stable deal. You're going to want to make sure you have a higher quality anchor tenant, not necessarily in the Amazons of the world or a Fortune 500 company, but a reputable company that's been around for a while, ideally has more than one location. Maybe this is their HQ, has done well throughout COVID. You want to make sure that you have a quality anchor in place, because that can remove a lot of risk off the table from the get-go. And then, the other tenants, the smaller tenants in the building, they may not all be perfect from a credit perspective, but how long have they been at the building? Do they have a track record of paying their rents on time? Have they been a problem child? It's those items that you can just take a few minutes to research that can add a lot of comfort or discomfort in a potential investment opportunity. And one kind of thing I really focus on is the weighted average lease term at a building or a property. And basically what that is the average amount of lease term remaining given the size of the tenant at the building. So if it's 3 or 4 years or greater, you're going to come into the investment with stability, which is something that is much preferred. You don't want to enter an investment out of the gate and have a high risk of a major tenant leaving. And then the last item, not really the last item, but the third item that's very important to focus on is the overall strategy that the sponsor is pitching for this investment. Any building could be a great investment, but it all depends on the strategy. Does it make sense? Are the assumptions that they're communicating to you in their investment summary or their investment package, are they achievable? If, for example, the plan is to buy a building that is 50% occupied, what assumptions are they making on the leasing side? Are they telling you we're going to have this leased up in 3 months, 12 months, 18 months? What rental rates are they assuming in that lease up? Those are all very important things to consider. If they're telling you they're going to buy a building and immediately lease it up within a few months, that's probably not that achievable, not that realistic. So maybe the return profile is a little overstated. Other items to consider are the debt that they have included in their model. Is the leverage point? Are you comfortable with that? Is it too high? Is it too low? Obviously a model compared to what happens in real life, it's very difficult to make that track perfectly. But if the assumptions in the strategy make sense and are suitable for the building and its location, generally, you're on the right track there. And then, lastly, all these types of deals, there's, an unlimited amount of different types of real estate deals: single tenant, multi-tenant, retail, office, medical office, industrial, self-storage, etc. They're all going to have their own little quirks that you want to review as well. But generally speaking, the location of a building, the quality of its tenants, and the suitability of the strategy that the sponsor has laid out for you are the main items that you want to get really comfortable with when considering an investment.